Welcome back to Squawk on the Street. New data on housing this morning as well. It's been a data dump few days. April building permits coming in a little bit lighter than expected, while housing starts did meet expectations. This after, remember, homebuilders sentiment yesterday fell this week to its lowest level in years. Joining us to talk about what's going on in the housing market is John Lovallo, UBS Homebuilders building products analyst, and Logan Mohtashami, Housing Wire lead analyst. It's good to have both of you here. Just Logan, big picture, what's the story right now?
Homeowners need lower mortgage rates. Active completed units are back to historical high levels. Traditionally, that's typically the end of the cycle for them. As supply increases and margin pressures, they are not in a mood to start building a lot more homes. And the Builders' Confidence Index is 4 points away from the all-time low we saw in COVID.
And yet, John, you still like these names, even though sentiment is souring and activity has been so sluggish. Why?
Look, I think the builders have done the appropriate thing, and that is to pull back on starts and not push volume out into the market, right? So they're remaining disciplined. That demand is still very strong, the underlying demand. In fact, we have a survey out, the most recent version, one of the longest standing surveys on the street. 32% of respondents want to buy a home within the next 12 months. That compares to the long-term average of 30% and the pre-COVID average of 25%. The intent to buy and the desire to buy is there. We just need affordability to get in a better place. Now, the home builders are doing the right thing, and they're buying down mortgage rates and helping along the financing. So what we need to happen is things to sort of settle politically. Consumer confidence, we saw the numbers today, that to stabilize to some extent. And then you know what? I think we're going to be in a very good position for the builders to do well.
Aren't prices finally coming down, though?
Prices are pretty sticky. There's certain markets where we're seeing some adjustments. Inventory is up in certain markets. But you know what? I think that the builders, again, are executing properly, doing the right things, and that inventory will get worked down. And as we move through the end of this year and into next year, we're going to be in a really good spot for the builders and these stocks.
Logan, how low does the average mortgage rate need to be before buyers can hold their nose and spend? Does it still need to be a 5 handle?
No, you know, when mortgage rates get now near to 6%, builder sentiment improves. So the 10-year yield going lower, mortgage rates going lower, builders can sell product. Except near 7% or above, it doesn't work that well for them. Again, margin pressure here. But if the 10-year yield and mortgage rates go just towards 6%, new home sales can grow, existing home sales can grow. Right now, that's the best we could have because monetary policy is not very pro-housing right now, but you don't need 3, 4, 5. Just getting down to 6% and holding that for some time can make it work for the new home sales market.
So, I mean, for so long, the swing factor, John, was inventory, right? That was what was keeping prices. And yes, mortgage rates, of course, important. What's happening there? You said that home builders are holding back a little now.
A little bit. I mean, inventory is actually not in a bad spot outside of certain markets. Think of the I-4 corridor in Florida, think about Austin, think about Phoenix, but all those markets are starting to get a little better. I agree with Logan. I think, the builders have been buying down rates to sort of between 5 and 5.5%. That's been a pretty good spot to get demand moving. And I think that, as we sort of move through the year, we're going to be in a spot where I think buyers are going to come back to the market. Now, keep in mind, this sentiment index that came out from the home builders, that's really private builders, smaller builders. They don't have the balance sheets or the access to financing that the publics do. So if you were to survey the publics, I think they would feel a little bit better.
Are you neutral on all the building products or materials because of tariffs?
Not neutral across the group. We certainly think there's opportunities. I think tariffs certainly present a risk, but also existing home sales at GFC trough levels, and that's the lock-in effect because rates did move up so quickly. The prevailing mortgage rate out there today is 4% versus the headline rate at 7%. People don't want to move. That makes it hard to do repair and remodel jobs.
There's the material cost, Logan. And sometimes if you talk to, for example, a lot of quick service restaurants, the issue of immigration and deportation and labor availability, some argue is even more important. How does that weigh versus materials and housing?
I'll always outweigh the 10-year yield over labor, material costs. President Trump wants lower mortgage rates because he saw what happened during COVID. Lumber prices were $1,500. We had inflation, but lower mortgage rates, builders were able to sell homes. So this, to me, will always be a 10-year yield story. Mortgage rates go lower, new home sales could grow, existing home sales grow. We just do not have policy right now. If the labor market starts to get weaker, housing could perform better because the 10-year yield should go lower in that environment.
Have we gotten any compression between mortgage rates and long-term Treasury yields?
It's a great question. Not yet. The average spread historically has been 170 basis points. We're probably closer to 250 today. That would certainly help if we saw some compression there.
Logan, so what's the outlook? I mean, not knowing exactly where rates are going, what do you think is going to happen to activity rest of the year?
The existing home sale market has actually had 15 straight weeks of positive year-over-year growth data. However, that's working from all-time lows. The builders, are still at 2019 levels. If the 10-year yield could just get down a little bit more, new home sales can grow, existing home sales can grow, but we've been very, very stubborn in keeping rates near 7% rather than near 6%. The 10-year yield rules everything right now, so we'll see how the rest of the year goes. Existing home sales market should perform a little bit better than the new home sale market this year.
All right. Thank you guys both for your predictions and talking us through housing, Logan and John.